So why Welland?
So, Ryan, why don't you share? You were born and raised,
Yeah,
right?
I'm born and raised in Welland. I mean, Welland's definitely, it's an up and coming town for sure. I think one of the biggest reasons to do, like especially if you're going to do a legal basement apartment in Welland, is the city is relatively easy to work with. That's probably one of the biggest things going for you. And then Welland as a whole is growing. Like it's going to be growing like 8,000 people in like the next 5-6 years. So it's obviously anytime you're going to be going into a booming town or a town that's growing, and then also the town is also kind of like pro-business, so that you can get projects done, and there's not a lot of red tape to go through. Makes it a lot easier for an investor. So.
Yeah, and for context, right now the population of Welland is like 50,000.
50,000.
So 8,000 people, that's almost like a 20% like increase in population here. And we are still within 15 minutes of St. Catharines, 15 minutes of Niagara Falls. So like the population base within like a short driving distance is probably around 300, maybe more.
Probably almost closer to, if you include the suburbs and everything, in
Yeah.
15, you're probably almost close to 500,000 people.
Yeah. Which is the population of the city of Hamilton, right? So we almost get that much in terms of businesses. These are their customers. These are the jobs that our tenants are trying to get. But because we're in a smaller town, we get homes at more attractive prices, but we still almost get the same rents, which is...
Yeah, the rents in Welland for the home prices is like kind of crazy actually.
Yeah.
Because if you compare it to like even Hamilton, like the rents aren't that much different, and the prices are definitely
way higher.
Yeah, way higher, exactly.
Yeah, like we were just looking for a client of ours in the city of Hamilton. We just put an offer on we lost in multiple offers on a 2-bedroom bungalow that was going to be worth 600,000 once all the renovations and everything was done. But the rents were going to be the same as a property you could buy here for maybe all in 450, maybe 500, right? So your cash flows just by that alone are probably $400 or $500 more a month.
So can I ask something? What do you mean? What is the difference between a rent versus a price? If you said something about the rents being really insane here compared to Hamilton, but
yeah. So when you're an investor, the amount of rent you get matters, but in proportion to the price you're paying for the property. So for example, if you're buying a home like this in Toronto and you're paying $1 million for the property, the rent you get is not going to be 3 times the rent that's here. So if we're getting around 3,000, you're likely not going to get $9,000 in rent, right? You may get more than here for sure, but it may only be like, call it 5,000, right? Between an up and a down, and you're getting 3,000 here, but you're paying 3 times the price. So the reason this matters is, as an investor, you have fixed expenses. So when you buy a property, you have your mortgage payment, you have your property taxes, you have your insurance, right? In this case, Dave, the owner of the home's paying for the gas and the water, and the tenants are paying for the electricity, right? So he has these fixed expenses. The mortgage, however, is the biggest expense. So if he's able to buy this home here for $375 and get $3,000, $3,200 in rent, after paying his mortgage payments and his fixed expenses, he now has a surplus, right? A profit. That's his cash flow. And it's not really money that, whenever we talk about having cash flow with an investment property, I always put a caveat that this is not money you can just live off of or spend on a vacation, right? You want to build up a reserve, because beyond the fixed expenses, there are expenses that will come up when you own a property like this. Like there may be a plumbing leak, or an appliance may break, you may need to get it repaired or replaced, right? There are things that come up. So I always recommend build up a savings even for each of these properties, but you want to have a positive cash flow, which is more income than your expenses every month. So the same property in, for example, Toronto, if you're paying $1 million for it and you're getting $5,000 in rent, you may not have a positive surplus, because your mortgage payment on $1 million purchase price may eat up maybe most of that rent, to the point where you're breaking even on your fixed expenses, and you may actually be negative cash flow on your variable expenses. So if a plumbing leak happens, something breaks, right? You're paying that out of pocket every month. So a big reason why most of the investors we work with come to cities like Welland is so that they can have this positive cash flow, right? Because like for example, the client who owns this property now owns, in the last year or so, he's bought 3 properties, but all of them have been with this same formula of buying a cash flow positive property, and all of them have been duplexes, right? So there's 2 units up and down, and this way, between the 3, he probably bought $1.2, $1.3 million worth of real estate, except that each of them are cash flow positive, versus the guy who buys the $1 million home in Toronto, he'll have just the 1 property, but he just has the 2 tenants, and he may be breaking even or even negative, right? So just a different approach to investing, because the reason so in Ontario, we were chatting about this even on our drive yesterday, we've had a pretty good run for the last 25 years. So real estate prices have just kept going up and up. So it's created this environment where everyone thinks you buy a rental property, you buy any property, you're going to make money. And so far that's been correct. However, when we look at cities like Edmonton, Saskatoon, many cities in Quebec, that has not been the case. Even though those cities actually have immigration, they have the same low interest rates, they have many of the same factors. The one factor we have that's a little bit different is the amount of immigration is a little bit more in Toronto and in sort of the Vancouver area. So that may be fueling part of this growth. But in my mind, I'm always thinking, how do I mitigate the risks we take, right? If I'm buying or recommending my clients to buy properties that are negative cash flow, if there's a real estate downturn for a couple of years, they're now in a tough position, because if they sell the property, they lose money. If they don't sell the property, they're feeding it every single month. They're paying out of their own salary, out of their own pocket to keep it going, which I think is a very difficult position that I don't want. Like I don't want to be in that position, right? Any investment property I buy, I want it to have at least a little bit of a surplus, so that, you know what, if something crazy happens, like COVID, for example, this year was a very good example. No one really predicted COVID was going to happen last year. Now, we've been fortunate that the real estate market hasn't tanked as a result of COVID. In fact, quite the opposite
Yeah.
right now, in terms of just everything selling in multiple offers. But who knows what the next few years bring, right? If something crazy happens, say mortgage rules tighten to the point that people can't get a mortgage easily, that could very, very well impact the real estate market very directly within a short period of time. We never want to be in the position where we're forced to sell a property in a rush, because in my mind, I'm thinking, what's the worst case scenario? How do we protect ourselves from it? Even in my own life, I make my income working as a realtor. If there's a real estate downturn, my income may significantly decrease, right? In that environment, if I also own rental properties that are cash flow negative, I may no longer be able to pay those expenses because my income has decreased. So I'm also thinking for my clients, it may be the same situation. They may be in industries that if the real estate market tanks, it's usually because of some broader economic downturn. There's probably something like COVID, for example. There may be something bigger happening that may affect their job, may affect their business. If they're in that environment, in that situation, and they have properties that are costing them every month, that's a really bad combination, right? So some of my clients, like most of my clients actually are from Toronto, Mississauga, Oakville, and they kind of ask me, why are we going all the way out to Welland? Because for many of them, when I talk about Welland for the first time, it's like even our conversation on our way here, Charles, most of them don't actually know where Welland is, or like I have to almost show them on a map. You drive to Niagara Falls, you take a little detour, you get to Welland, right? But the reason we come out this far, so we're now about an hour and a half away from Toronto, is so that we can buy properties at more affordable prices, but we're still able to get good rents. And as a result, that combination allows us to have that surplus every month. So kind of the long answer to your question there.
No, it's good. That was like a video in itself.